Did you know that investing sustainably does not mean giving up returns, but rather enriching your portfolio with opportunities that look to the future? Adding a green component is not only an ethical choice, but a strategy that can offer stability and growth potential over the long term. When I began exploring how to integrate sustainable investments, I discovered that the journey starts more in the mind than in the numbers. It requires a mindset shift that values environmental impact alongside financial results. To begin, imagine your portfolio as an ecosystem. Each investment is an element interacting with the others. If you add green assets, you are not only diversifying, but you are planting seeds that can flourish as the economy transitions to low emissions. This does not mean abandoning traditional securities entirely, but rather finding a dynamic balance, one portion dedicated to solutions supporting renewable energy, energy efficiency, or clean technologies, alongside more established instruments. In this way, the portfolio reflects not only the desire to protect capital, but also the wish to contribute to a more resilient system. I learned early on that there are different ways to start. One of the first steps is to research thematic funds or ETFs focused on sustainability. These vehicles pool money from many investors and direct it toward companies or projects that meet environmental criteria. You do not need a large amount. Often, it is possible to begin with accessible sums. I myself evaluated a fund that selected companies committed to reducing emissions or producing green technologies. Reading the investment policy document helped me understand which indicators they use to decide if a company is genuinely sustainable and which sectors they prioritize. Another approach is to include green bonds issued by public entities or solid enterprises. These securities allocate proceeds to concrete projects like solar installations, efficiency retrofits, or clean infrastructure. I discovered that, compared to traditional bonds, green bonds can offer a similar yield while supporting traceable environmental initiatives. In the issuance documents, you often find a green framework explaining how funds will be used and which reports will be published to show progress. Reading these details helps you feel part of a real change. Alongside funds and bonds, there are opportunities for direct investment in local projects or innovative startups. In some cases, you can participate in equity crowdfunding campaigns for companies developing clean solutions. Think of it as a way to personally support ideas that can transform sectors. When I examined certain campaigns, I assessed the team's credibility, the market potential, and the economic sustainability alongside the environmental benefit. Although this involves higher risk compared to a diversified fund, it forms part of a path that blends learning and direct involvement. An often underestimated element is evaluating the specific risk of companies or projects. For each one, you need to investigate financial solidity, governance, and transparency. I spent time reading sustainability reports and ESG ratings to understand how environmental results are monitored. This approach helps avoid the illusion of greenwashing, proposals that seem sustainable but actually lack concrete guarantees. Asking, does the company make verifiable data available? Are projects overseen by independent third parties? These are questions I learned to ask for more confident selection. Finally, it is essential to define a time horizon and set a green allocation percentage consistent with your risk tolerance. It is not a fixed quota forever. At first, it can be modest, then it evolves as confidence grows and experience accumulates. In my case, I decided to allocate a gradually increasing portion as I observed results and compared notes with communities of responsible investors. This gradual approach reduces initial anxiety and leaves room for continuous learning. With this vision and these first steps, the portfolio begins to include elements oriented toward tomorrow, combining returns and sustainability. Now let's delve into concrete aspects to make the portfolio increasingly green, maintaining a flexible approach focused on continuous learning. Imagine you have already included an initial share of sustainable investments. Now it is about refining choices, monitoring consistently, and exploiting additional opportunities without losing sight of overall balance. A fundamental point is periodic monitoring of the companies or projects in which you have invested. Even when investing in thematic funds or ETFs dedicated to sustainability, it is worthwhile to check quarterly or semi-annual reports that describe the performance of underlying assets. Observe whether companies maintain their declared environmental commitments, whether new developments emerge in the sector, or whether unexpected risks arise. This allows you to react in a timely manner. For example, if a fund changes its company selection strategy, you can decide whether to stay or look for alternatives aligned with your values. At the same time, it is useful to explore new niches of sustainable investment. Behind a generalist sustainability fund, there may be innovative sectors such as the circular economy, smart water resource management, or financing startups offering low-impact mobility solutions. Learning about these trends helps you identify specific vehicles that could offer diversification advantages and higher growth potential. For example, if you notice that particular initiatives are developing in your geographic area or in emerging markets, you can consider investing via crowdfunding platforms or sector-specific funds that support these solutions. Another element concerns managing volatility. Even green investments can be affected by market fluctuations, especially if linked to emerging sectors or technologies still in development. To address this aspect, it is useful to establish an emotional tolerance threshold in advance. Recognize how much temporary decline you are willing to endure. This way, you avoid impulsive decisions during periods of oscillation. I discovered that whenever I faced a perceived drop in value of a sustainable investment, focusing on the fundamental aspects of the project or company helped me stay calm. I asked myself, is the sustainability plan proceeding as expected? Are environmental results still being measured? If the answer was yes, I held the position with confidence. A frequently overlooked aspect is evaluating purchase and sale conditions. When investing in green bonds or funds, check if there are particular windows or entry and exit fees that could erode returns. Knowing these conditions allows you to plan purchases at favorable times and sell with awareness when rebalancing is appropriate. If you invest through online platforms, explore recurring order features. For instance, scheduling small periodic contributions to a sustainable fund helps reduce the impact of price fluctuations and build the position gradually. The tax aspect deserves detailed attention. In some countries, there are specific incentives for those investing in sustainable instruments or environmental projects. Research tax deductions, exemptions, or credits that can improve net returns. This requires consulting official sources or professionals in the field, but the benefit can be significant. Reducing tax burden means obtaining a higher share of return compared to traditional opportunities. Moreover, some jurisdictions promote green investments with dedicated programs, and staying updated on potential regulatory changes can offer opportunities to access advantageous products. A further step is encouraging active selection. Although a passive approach through sustainable ETFs or index funds is often preferred, those with time and expertise can explore individual stocks or specific projects. In this case, you need to analyze financial statements and ESG metrics in depth, evaluate the company's growth path, its investment plans in clean technologies, and the real impact measured over time. I regularly devoted sessions to reading corporate sustainability reports, assessing indicators such as emission reductions, energy consumption, and environmental governance practices. This active selection requires commitment, but if done rigorously, it can yield interesting results. Equally important is building a network for discussion with other sustainable investors. Participating in online communities, discussion groups, or local meetups allows you to share experiences, discover new tools, and learn from others' mistakes. I noticed that hearing real-life success and failure stories helps avoid errors and identify effective strategies. Furthermore, the collaborative dimension fosters the spread of good practices and encourages a conscious approach, far from passing trends. The role of technology is increasingly central. There are platforms offering personalized dashboards to monitor the environmental impact of your portfolio, display sustainability indicators, and compare performance against traditional benchmarks. Using these tools facilitates informed decisions and ensures a clear view of portfolio evolution over time. In some cases, you can set alerts to change strategy if an asset deviates from predefined ESG criteria. An emerging topic concerns investments in transition finance, that is, instruments that support companies moving from high-impact models to greener practices. These assets can offer attractive returns while contributing to real change. Evaluating such opportunities means analyzing how a company plans its transition, which resources it allocates to research and development of clean solutions, and how it documents progress. Detailed reports and long-term investment plans are often needed. Reading this information carefully is key to understanding if the transition project is solid. At the same time, keep an eye on global megatrends: renewable energy, electric mobility, sustainable agriculture, circular economy, water management. These areas offer multiple entry points: funds, bonds, equity crowdfunding, or directly shares of leading companies. Understanding growth dynamics in these sectors helps calibrate green allocation proactively, anticipating potential opportunities before they become mainstream. Finally, cultivate an attitude of patience and adaptability. The path toward an increasingly green portfolio is not linear and requires time for both financial and impact results to mature. Avoid chasing every novelty, but remain open to developments. Each semi-annual or annual review is an occasion to reflect on progress, rebalance, and plan next steps. With consistency and curiosity, your portfolio becomes a living tool capable of generating financial value and contributing to a sustainable future. When you feel the foundation is solid, you can consider further increasing the green share, knowing you have built a strategy based on knowledge, rigor, and sharing. If you found this deep dive in the third and final video of the Green series useful, remember to subscribe to the channel and activate the notification bell so you don't miss upcoming content on sustainable finance, investment strategies, and ideas to grow your capital in harmony with the planet.